All opinions and views expressed by the speakers are not representative of views and opinions of RBC Dominion Securities, Inc. All information and opinions provided in this video are in good faith, but without legal responsibility.
Welcome back to the Wealth Management in Motion conversation. Today, we're going to dig in on 7 mistakes that might be costing you serious money. My name is Miles Durko. I'm with RBC Wealth Management right here with you in Winnipeg, Manitoba. The 7 mistakes that I see people make routinely with their investment portfolios are panic, euphoria, over-diversification, under-diversification, making tax-based decisions in their investment portfolio, speculating with their serious money, and investing for yield alone without taking on other considerations. Let's dig into it. When we talk about panic being a mistake in people's investment portfolios, I'm talking about doing the wrong thing with your investments at the wrong time. You see, the markets don't always go up, but over history and over enough time taken into perspective, they have marched up and up and up. But occasionally the markets go down, and sometimes they can go down very sharply. And what sometimes people do when the market goes down very sharply is they panic. And as I said, they do the wrong thing at the wrong time. And what they do is they sell their investments at a low point. We don't want to do that. I'm going to dig into some other material in our next video about the history of the markets and how we want to inoculate ourselves from panicking. But for now, suffice it to say, when the markets go down, you may want to stay the course if you still have trust and confidence in your investment portfolio. When it comes to the opposite of panic, I mentioned euphoria being a major mistake. Well, why is that? You know, again, while markets over the course of history have gone up and up and up, we don't want to look at our portfolio and one section of our portfolio and see that it's climbed faster and climbed higher than other sections of our portfolio and abandon a well thought out, well diversified portfolio in order to try and push all of our money into this one narrow area of our investments that seems to be outperforming the other areas. We want to maintain a sense of diversification and a sense of discipline. So while we don't want to panic when things get rough, we don't want to get euphoric when one section of our portfolio is doing substantially better than others. Diversification is so important. Diversification is the first line of defense when it comes to our investment portfolios, but we don't want to be over-diversified. And what is over-diversified? Well, I see this oftentimes when people are invested, particularly utilizing mutual funds. You see, a mutual fund can, even on its own, by definition, be a whole and complete portfolio. But sometimes I see in people's accounts, they're utilizing multiple mutual funds. And when I break them open, I look at what's inside these mutual funds, what I'm finding routinely is that instead of getting additional diversification by having these multiple funds in their account, they're actually achieving duplication. What I mean is that many of these mutual funds are in fact holding very similar investments or the exact same investments in different funds. So we're not actually achieving proper diversification. We're over-diversified, we're getting duplication. And as I was saying, diversification really does remain the first line of defense in a portfolio. But we don't want to be under-diversified. We don't want to hold such a small selection of investments in our portfolio that we in fact are grossly under-diversified. Because what that means is if that one sector or that one geographic region or that one asset class that you happen to be invested in is doing poorly, then your entirety of your portfolio is also doing poorly. So while we don't want to be over-diversified, we certainly don't want to be under-diversified. What I'd suggest we really want to be is just properly diversified. One thing that I'm going to say that is a mistake that I think that sometimes people can misunderstand is we don't want to solely make tax-based investment decisions in our portfolio. Yes, we absolutely want to be tax aware. Yes, we absolutely want to be tax efficient with our investments. But what we don't want to have happen is watch a particular investment in our portfolio go up and up and up over time, and then sit there looking at it and saying, I couldn't possibly trim off some of the gains. I couldn't possibly sell this investment now because look how much it's gained. Think about all the tax I'd have to pay. Because what happens sometimes is you sit on this position and you hold this position because you don't want to capitalize on the gain and you don't want to have to pay the tax associated with that gain. But then after having watched that investment go up and up and up, you simply watch it go down and down and down until you no longer have a tax problem. So we don't want to make our investment decisions based solely on tax, but we certainly do want to be tax aware and be tax efficient. I want to talk about speculating. Speculating when you think you're investing. And speculating in one's investment accounts usually happens socially. It happens between friends. It's when one friend sees the other at the community barbecue and says, hey, I got involved in this investment and I think they're really going to take off. They're going to have a technological breakthrough and they're going to go from, X dollars per share to multiple times higher by next week. It's going to be fantastic. I'm going to be rich. You should invest in this too. You'll be rich. We'll be rich together. Won't that be fantastic? We have to recognize the difference between a proper investment and a pipe dream, especially when it comes to something as important as a portfolio that is going to fund your retirement and potentially leave a legacy to your loved ones after you're gone. We do not want to speculate. We want to invest. We want to invest in things that not have a hope of making money in the future, but in my opinion, invest in things that actually do make money today. Companies that are actually profitable presently and share that profit with you, the investor, in the form of a dividend. And mistake number 7 is investing for yield alone without considering other risk factors within the investment. If we go back years, we could find investments in the fixed income space that would pay a pretty decent rate of return and interest rate versus what's available today. If you were buying a government bond or a GIC product from one of the major banks, you would be getting more interest back in the early 2000s versus what you're getting now about a quarter century later. So what some people are finding is there are some investment products that are still offering fairly lucrative sounding interest rates. But what's happening is they're not realizing the underlying risk that they're having to take on to get access to that higher interest rate. So what I believe is that return of principal is every bit as important as return on principal. Let's make sure that you understand your investments fully and don't just see that shiny object of an interest rate being offered. Let's understand the investment fully. These are the 7 biggest mistakes that I see people make in their investment portfolios that could be costing you real money. We're here to talk to you, to help you navigate around these mistakes. And I'm Miles Durko, and I'm right here with you in the heart of it all at Portage in Maine. Please remember to like and subscribe to the channel. We'll see you next time on Wealth Management in Motion.